Good morning, ladies and gentlemen, and welcome to the PPHE Hotel Group Introduction and 2021 Full-Year Results Investor Presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and can be submitted at any time using the Q&A tab situated on the right-hand corner of your screen. Please just simply type in your question at any time and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, we would like to submit the following poll, and I'm sure the company would be most grateful for your participation. And I'd now like to hand over to Daniel Koss, CFO from PPHE Hotel. Good morning, sir.
Thank you very much, Mark. Welcome to this presentation on PPHE Hotel Group. My name is Daniel Koss. I'm the CFO of PPHE. On my left, I have Greg Hegarty, Deputy CEO of PPHE, and on my right, I have Robert Henke, Head of Commercial of PPHE. Just as a small note, we were just informed that we have a scheduled fire alarm at 10:15. We'll try and talk over it as much as possible, but at the moment it becomes really loud. We will go on mute shortly and then pick up after the fire alarm is done. Apologies for that in advance. So just to start, we are a hospitality company. We're a bit different than others in the industry in the way that we build, we own, and we operate all of our assets. And special about us is that we have our own management platform to do so. And there's a few things that set us apart. The key features of that are that our founders are still very heavily involved in the company as management, but they also still hold 44% of the shares, which makes them true custodians of capital. And their entrepreneurial DNA is fully embraced by our executive team, and we all have over 10 years of tenure with the company. Our business model will give investors exposure to returns across the entire value chain of hospitality real estate. Because with our buy, build, operate model, we build ground up, we redevelop office blocks, and we have a strong capital recycling approach, which is important to say that we have not diluted shareholders since IPO. And we think that our hospitality management platform will give you a growth opportunity. So our focus is primarily on driving equity, growing the NAV. And we do that by building assets, by repositioning assets, but also by excelling operationally. We have a very disciplined capital allocation, and we have certain yield profile that we will present to you later. And our track record on the back of that is a total shareholder return since IPO of 224%, which includes a 2-year COVID period. And that's based on share price. We are currently trading quite substantially under our net asset value. If you look at the net asset value total return, we've been on 350% since IPO. And again, that includes a 2-year COVID period. And this is without diluting shareholders. Pre-COVID, we were also doing a 10-year double-digit compounded annual growth rate on revenue and EBITDA. So our strategy is really what makes us different. So we're an integrated developer, owner, and operator, and real estate really sits at the heart of our strategy. We have a very strong preference for assets with a development potential, such as ground-up developments, such as office refurbishment, office conversions, or tired hotel assets. And we like to have full control over every aspect in that value chain. Our portfolio is very diversified. We predominantly focus on Europe, which is the world's largest growth market. And we have 2 distinct segments. One is leisure and outdoor, and one is key city center. We have a unique approach to our capital structure. It is fully self-funded through capital recycling. And when we raise capital at the asset level and not diluting PPHE shareholders. And we do that by raising debt, but we also raise third-party equity on our assets. And as I said, quite special about us is that we have a fully scalable management platform with an exclusive relationship with Radisson Hotel Group. So usually REITs or hospitality landowners, they need third-party operators to operate their assets, but we have our own platform. And this platform growth is growing as a standalone value. So we grow it on the back of our own assets, on assets that we jointly own as a majority or a minority, but we also manage third-party assets. And the agreements in this platform are typically long-term, They provide a fee base that is based on the revenue and the profit of the underlying hotel, providing an upside on hotel trading. So this circle here summarizes what I just said on the previous slide. We typically buy land, we buy an office block, we buy a tired hotel, which we then develop or redevelop. We put our own operating people in there, our general management and our brands, and we create a lot of value. And that value we typically take out and recycle back into the business. And that's how we grow shareholder value. And on this slide, I'm trying to illustrate the capital growth and how this capital recycling works. So you see that since IPO, our total capital structure has grown over 600%. But you can see that the PPHE equity holder element only grew over 100%, which is mainly retained profits. And that's with our properties at historical cost and book value. And like I just said, we create a lot of value on top of that cost. And the slide on the right side, the horseshoe, reflects that. So you see that the majority of our capital is PPHE shareholder equity, representing 40% of the total capital. 17% of the total capital is minority equity, that's equity raised at the asset level. A key characteristic there is that we have protective arrangements on both sides. So we are never stuck with each other. There's always a way to exit the relationship. And then if we go to the more debt-like structures, 11% of our capital is based off ground rents. So the liability you see there is future ground rent payments. And a key characteristic here is that these are non-recourse, asset-backed, they have no covenants, and the majority have 100 years maturity. And then obviously we also have normal mortgage bank debt. Our bank debt is typically non-recourse and asset-backed. Our net bank debt leverage sits at a conservative 33% currently. The cost of debt sits at 3.1%, and the average maturity profile is currently 5.3 years. So with this model, as I said, we've created quite a bit of returns for shareholders. And we feel that these are on this slide, we will present two real estate KPIs to you. On the left side, we have the NAV per share, the EPRA NRV per share. We IPO'd for £5.50 in 2007, and currently after COVID, we report a NAV per share of £22.50. And it's important to say that £4.68 of this NAV is not yielding at the moment, because in any point of time, we will be building new hotels. So this 4.68 represents hotels that we are currently building or redeveloping, and it represents an excess cash that is there to deploy for further growth. If you go to the right side of the table, this is an important metric. This metric it's called EPRA, adjusted EPRA earnings. In the US, they call it FFO. You can also call it recurring cash flow per share. This metric gives you the return of the operations less the cost of the capital structure that I just presented to you. And pre-COVID, we were doing £1.28 per share on that. And we typically pay out 30% that in dividends, which usually we have a progressive dividend policy. If we're on this slide, we've had a rough period in the last 2 years. We think the majority of that is over, we hope, and we want to look forward again. So if you look pre-COVID, we were reporting a NAV close to £26 per share. Our EPRA earnings were £1.28 per share. And our platform was making 10 million EBITDA. And as you can see in the middle, COVID has affected that. So £22 NAV as we speak, and a cash flow loss and an EBITDA management loss. So we want to take that forward, and our ambition in the medium term is to bring NAV to £27 per share, to have our cash flow earnings at £1.70 per share, and to bring the hospitality platform to 15 million EBITDA. And we're going to do that by focusing on real estate returns, 6% on new acquisitions, 7.5% on new developments, and we do 10% on repositioning capex. And that is unlevered. So if we put leverage or capital recycling against that, we hope to achieve double-digit returns on our real estate assets. On the right side, you see how we want to grow the management platform. It's predominantly building scale through our own portfolio, which is either majority, minority owned, or third-party owned. So the growth very much coincides with the asset base.
Thanks, Daniel. So where are we today? We currently have a portfolio of 48 properties in operation, which is mainly consisting of freehold and long leasehold assets in Europe. Our strategy is twofold. We have city center hotels, typically in prime city center locations, close to main attractions and landmarks, as well as corporate offices. And then we have the resorts, camping and glamping and outdoor sort of business unit. We currently use a number of commercial brands, mainly in the upper upscale segment of the market. And in Croatia, we have a mid-market offering as well, predominantly within the campsites. So in the UK market space, Park Plaza is what people know us for mainly. We have a significant estate in London, and I'll touch on that a bit later in the presentation. We have an art hotel brand, which is upper upscale lifestyle. And we have some exciting pipeline projects within that brand, which Greg will touch on in a few minutes. We are active in 8 countries. So the majority of our properties sit in the UK. From a valuation point of view, the Netherlands is an important market where Amsterdam sits at our core. Germany, Serbia, Italy, Hungary, Austria, and Croatia. 3 of those countries were added in the last 2 years. So we were very pleased to be entering Serbia and Austria, and more recently Italy, with the acquisition of a hotel in Rome, which we'll touch on a bit later. The 1.8 billion valuation is done by external companies, so Savills mainly, as well as an entity which is part of UniCredit. So moving on to the next slide. This is our geographic spread. So within the UK, we have a number of provincial cities, but the bulk of our estate sits in London, where we also have a sort of sizable office and support team in place. In the Netherlands, most of our properties sit in Amsterdam, and then we have 2 provincial hotels in Utrecht and Eindhoven. We have hotels in Germany, from Berlin to Nuremberg and Cologne, Budapest in Hungary, more recently in Belgrade, as I mentioned, and a large concentration of hotels on the Croatian coast in Istria, which is all within driving distance from key tourist markets for our portfolio, such as Germany, Austria, and Italy. And we were very pleased to be entering Italy in November last year. On the right, we see our exposure and footprint in London. We are one of the largest owner-operators in the London market within the upper upscale segment of the hotel industry. We have 3,200 rooms in operation in London today, with the potential and development pipeline of another 1,100 rooms. We have 2,500 rooms on the South Bank, including our flagship hotel, which is Park Plaza Westminster Bridge, that sits opposite the Big Ben and the House of Parliament. And we have 2 exciting projects in the pipeline for Art Hotel, one in Hoxton and one in Battersea, which Greg will expand upon. Our offering in London, especially, is very diverse. So we have hotels that cater to different market segments throughout the year. So we're very closely located to some of the main corporate clients in the London market. But our room stock and product is also very attractive to the family and leisure market. So throughout the pandemic, we've really been able to shift market segments and drive demand through leisure predominantly, which is currently the leading segment. So we have a lot of family rooms. Most of our hotels have swimming pools and health and leisure facilities. So we're well placed and well recognized, particularly in the London market. When we look at the next slide, we see sort of the context of that 1.8 billion in value. So nearly 50% of that sits in the UK, which is on the pie chart on the left. The yellow is well over 900 million of the value sits in the UK, and most of that is London. So Leeds and Nottingham only have a small proportion of this. The next biggest market for us in terms of real estate ownership is the Netherlands, and that's mainly in Amsterdam, where we have 3 hotels in the city center and 1 at the airport. Croatia is a large segment for us with a number of resorts, hotels, and campsites and glamping products. So in the last few years, we've been investing and transforming some of our campsites into glamping offerings, allowing us to command a premium rate and return on those assets. And that's what Daniel referenced as a repositioning project, where we take something that is maybe a bit tired or 2-star, 3-star, invest, and then relaunch it as a 4-star plus offering. And then we have assets in Germany and other markets such as Italy and Serbia. On the right, we see the split between city center and leisure and outdoor. So we are active in 17 cities today with our properties across the 8 markets that I mentioned. The operating platform that we have sets us apart from many of our peers. So we have the real estate at the heart of the business, but we also have our own management company. And that management company is a team of specialists in every discipline that one needs to operate a hotel or a hospitality asset. So sales, revenue, HR, accounting, legal, all the back office functions to drive the day-to-day operation of a hotel is provided by us. So we don't need to engage with third-party management companies. We have a team of specialists that is located across London, Amsterdam, Berlin, and Pula in our offices there. And basically, what they do is they deliver the day-to-day operation and drive the performance of the assets. We do believe there's a lot more scope to grow the platform. And we have some examples where we not only manage PPHE owned assets, but we also manage assets on behalf of our joint venture partners. And we have third-party management arrangements where we manage properties on behalf of other owners, third-party owners. We have a hotel coming online in the second half of this year, which is a pure management agreement as well. And the owner recognized our infrastructure and sort of best-in-class performance throughout the history of our group. We have our own housekeeping agency in London, which is unique in the marketplace. And that's really helped us to manage through the pandemic, whilst we're obviously, as an industry, facing staff shortages. We took the decision to insource housekeeping as a preparation for Brexit. And that's been one of our best decisions in the last few years, given the flexibility we now have to move the workforce across the different units. Revenue management is at the heart of our business. So our teams are targeted to really sort of make the most of every single revenue opportunity, be it for food and beverage, restaurant rooms, meeting and events, and so on. We have a lot of industry recognition throughout the history of the group, and we were very pleased that in 2021, despite the pandemic, we were voted and elected as the best employer in hospitality in the UK. That was awarded by the Caterer, which is the leading trade publication in the UK. And that's a major external recognition for our group. Just before COVID started, we were also awarded the AA Hotel Group of the Year award. So it's not just us talking about how excellent our team has been working throughout the pandemic, but it's also external accreditation that helps us to position the business. Moving on to the next slide. One of the key drivers of value for us as a management company is the access to Radisson Hotel Group. So we are independent owner-operator of hospitality assets, but we utilize the Park Plaza brand under an exclusive license from Radisson. So Radisson is a well-known and very well-established hotel company. They have over 1,600 hotels across the world. Under their ownership, which is a Chinese conglomerate, it's actually the second largest hotel group in the world after Marriott. So how and where do we work with them? Basically, under a perpetual and exclusive license, we are the exclusive master franchisee for Europe, Middle East, and Africa to operate and develop Park Plaza branded hotels. What that allows us to do, we can market our hotel assets that are Park Plaza branded through Radisson's reservation system, their infrastructure and connectivity towards business travel agents, meeting planners, online travel agents, and basically allowing us to market our product globally. Radisson also develops and operates the technology infrastructure to support all this activity, as well as the websites, mobile apps, and the loyalty schemes that are attached to this. So Radisson Rewards is a database currently of well over 24 million frequent travelers, and we have then the access and ability to market our products to the members with targeted campaigns and offers. In addition, we can leverage their sales teams, sales activities, their global marketing, PR, and buying power. And buying power is a lot of commercial agreements, including reduced commissions with key travel agents and online booking websites, for example. This license is unique. These sort of arrangements are not done necessarily in today's marketplace. This is an historic arrangement, and through various ownership changes in sort of the history of the Park Plaza brand, Radisson is now the owner of the brand, and we are the owner of the European license, basically. We also market our art hotel properties through the same arrangement. So it gives us scope to develop art hotel as a global brand. Greg will take us through the pipeline. We have some exciting art hotel projects in the pipeline, and over to you, Greg.
Okay, thank you, Robert. So the third area of growth we want to show you here is our real estate pipeline. The real estate pipeline currently has 9 active projects there, with over £200 million worth of capital deployed within these projects. These projects typically are from ground up development, office conversions, or actually repositioned portfolios. And there's a selection of them, as we can see across there. I will talk about a few of them in a moment, but as well as I talked about the pipeline, we want to talk a little bit more about the platform and how we aim to recover as we go through in this section. Looking at Art Hotel London Battersea, this is our imminent opening, which is due to open in Q3 of 2022. It's a significant property at Battersea Power Station. It will be our first London art hotel, which Robert has already alluded to, operates in the upper upscale lifestyle segment. Beautiful property overlooking the power station. It's iconic. It will be 164 rooms, and we are really looking forward to that opening. One notable fact about this property for PPHE, it will be our first management contract, third-party management contract for the Art Hotel brand. So something we're looking forward to operating. The second project of note in London is the Art Hotel London Hoxton. As you can see there, it's a £280 million project. It's already well underway. This is currently at the 24th floor out of 27th in current development. We see the Art Hotel London Hoxton opening in 2024, 343 rooms, significant office space there also, so it's a mixed use scheme with galleries, media areas, so it's a really exciting property in the tech city of Shoreditch. We have 2 Banksys which we're going to portray in there, so it's an exciting project for us significantly. The next imminent opening is the Grand Hotel Brioni in Croatia. This is a beautiful luxury asset class property which is located overlooking the island of Brioni. It's a 227 room business, a £30 million reposition project here, and we are opening that in April. And as we go through there in terms of a pipeline, a very good example of our repositioning of an asset will be the Art Hotel in Rome, Italy. Earlier this year, we purchased a property in Rome near Via Vento. It's currently, an operating and trading business. However, we will be deploying £10 million worth of capex into that business and repositioning it as our Art Hotel in Rome. So significant growth coming through the Art Hotel portfolio there. Thank you. The other area I want to talk about is the management platform. Now, our management platform back in 2019 generated £10 million worth of EBITDA. And what we wanted to say is the future opportunity of that management platform, just based off the pipeline, coupled with the recovery of the sector, we have a medium-term EBITDA ambition to grow that platform to £15 million. Albeit through the new openings of what you can see are happening this year and into next, the recovery of the sector, new acquisitions, which we are still currently looking at from a development point of view. Our development team is very active out in the market. We are dealing with joint ventures, third-party management contracts to grow this area. And what is one thing to note, because of the scale and infrastructure of the PPHE team, we don't foresee any upscaling needed, and we should be able to use the tacit knowledge within the business to continue. So, as I've already said, what I want to talk about now is how we are seeing the business, how it is evolving post-COVID, well, not post-COVID, but operating out of a COVID environment. As we've seen, it's been very, dynamic and challenging for the hospitality sector. However, from our point of view, investors can very much benefit from an industry that is recovering from the most disrupted period ever. With our strategy and our model, we are able to quickly respond to the current market trends, and these have been demonstrated throughout our performance in 2020 and 2021. Trends we are currently seeing is very, very strong domestic travel in all of our operating regions, which is dominated by the leisure market currently. We had one of our most successful half terms in February, just gone now, in the UK, where we actually had the highest occupancies since COVID and 2019 levels. Corporate travel is still quite uncertain. It is starting to come back to the UK, but it is heavily disrupted. We are getting more and more green shoots in this sector. However, if we were operating a corporate hotel business alone, we would be finding that a bit challenging. All of our hotels currently are city centre hotels, which cater for both leisure and corporate due to our strong locations, which enable us to adapt between segments. We have a strong driven leisure market, and we've always actually managed to dominate this market, especially in London and in Amsterdam, where Robert's already alluded to. We do cater our businesses towards the family market during those leisure times, but also our properties have very high-end quality food and beverage and leisure. And for example, the most of the London portfolio has swimming pools in their domain, which actually does drive significant demand. The future of travel patterns are remaining unclear. However, we are monitoring them. One thing we can see is there is a return to aviation, especially into the UK market. Aviation patterns are increasing, crew patterns are increasing within the business, which is very, very promising indeed. Also, what we are seeing, there is a change in customer trends towards digitalization. Whilst we knew that this was happening, it's very much been accelerated in COVID. And PPHE in 2020 and 2021 heavily invested in this area. So we are perfectly repositioned to actually manage that transition of digitalization. You can now check in online, check out online, book a room online, integrate with the food and beverage teams from your bedroom, from your mobile device, as well as being able to change the channel of your television. So it is really, really well progressed indeed. So our digitalization and mobilization strategy, which we did through COVID, we're particularly proud of. But one area which is key to note, and one thing we do have to bear in mind, and Daniel has already touched on it, the hospitality industry is having the largest challenge it has ever had with resources. Now, what we are seeing is actually in post-COVID is actually the true impact of Brexit. Now the situation is normalizing in the UK. We do have a significant amount of changes within our portfolio in terms of our labour challenges. As Robert's already alluded to, we have insourced our housekeeping department. That has enabled us to actually manage all of those peaks and troughs of occupancy. It has also allowed us to make sure that our team members are well looked after and maintained. And as Robert already mentioned, that we did win Best Employer in Hospitality. So that has allowed us to attract talent. I'm not saying it's not without its challenges and cost pressures. However, we are doing as much as we can to mitigate that impact. Okay, moving on to what's happening for the future and what did we do really in 2021. Okay, in 2021, now looking back, you know, during the second half of 2021, it was a disrupted period, both in UK and most notably also in Holland, in our Dutch portfolio, which is just starting to unlock now, along with the German portfolio. During this period, we faced, as you're all aware, many government restrictions, but being able to adapt to that, you know, with the agility and flexibility of our management team and actually being well versed with this, we are able to protect our operational results as we went through. However, we did actually have some golden nuggets of business during this impact.
We will go on mute slightly because of the fire alarm. So we will go on.
No. That's no problem at all. Ladies and gentlemen, as Daniel highlighted at the start of today's presentation, there is a scheduled fire alarm, which unfortunately these things happen when you have live investor presentations. So please do bear with us. Just a reminder, whilst we wait for the alarm to switch off, that you can submit your questions. If you just open the Q&A tab on the right-hand side of your screen, you'll see the Q&A tab there, and please just simply type in your questions and press send. Of course, as soon as Daniel and the team have gone through the fire alarm, we'll recommence with the presentation. I will come on intermittently just to tell you that we're still here, and to make sure that you don't think that we've lost connection. So please do bear with us. Thank you.
Thank you, Mark. I think we had the worst, so Greg will continue.
Perfect. Thank you very much indeed. Back to you, sir.
Thanks, Daniel. Apologies for that. So once again, I'll start from where I left. We had some golden nuggets of business in the portfolio during 2021. We had two properties, Park Plaza Waterloo and Park Plaza Victoria, which were 100% allocated to the government quarantine programme. And secondly, business sales and marketing initiative in 2020, positioning our significant conference and banqueting hotels here on the South Bank as bubble venues, because what we were getting is lots of inquiries about, could you still hold an event for 1,000 people, but give it for exclusive use? Just one moment, please. Okay, I'm just going to progress. So one notable bit of business we had actually was for Westminster Bridge in June last year, which was actually the Wimbledon bubble. And when I say the Wimbledon bubble, we actually were two destinations with the Old English Tennis Club in Wimbledon, and actually Park Plaza Westminster Bridge was the venue where every single player, every single physiotherapist, all the food and beverage teams, transports, logistical and offers, and actually COVID testing centres for the event were all located at the Park Plaza Westminster Bridge. One other success which we actually did in 2021 was unlocking £114 million worth of capital. We sold a 49% share of the Park Plaza Riverbank in London and 49% share of a development opportunity in our Art Hotel Hoxton. And one positive note to say to this was done at the group's NAV, which was really, really positive indeed. We also did two further strategic expansions. One was a 144-room hotel in Austria. That hotel complements our outdoor sector of strategic areas. And the second one, as I've already alluded to, was the Art Hotel Hoxton in Rome. And I've talked a little bit about the pipeline previously, over £200 million worth of capital deployed over London Hoxton, Grand Hotel Brioni, what we're doing in Rome, and the Battersea Art Station.
So going into the numbers a little bit deeper, we've obviously have been heavily impacted by COVID. So if we look at the property KPIs, we reported a NAV of £22.50 last year. If you look at pre-COVID, this is down from £26. And if we zoom in a little bit, £3 of that decrease is predominantly caused by the retained losses. In terms of property values, we are still 70p per share behind the property values of 2019. And if we zoom in into the details, Croatia is up from its 19 valuations due to the strong season and the heavy investments that we did during COVID. And the city centre locations in the UK, the Netherlands and Germany are still slightly behind on their 2019 valuation. Valuations are externally performed by Savills and based on a discounted cash flow. So the more bad news we have behind us, the more we should restore values back to the 2019. You can see that we report an EPRA earnings loss of 44p, down from the loss of 123 in 2020. Although we were operationally profitable, we still had debt service that made us cash flow negative. And that's also unfortunately why we have not suggested to pay a final dividend this year. The significant subsidies paired with the cash flow loss, we don't think it's appropriate or sustainable. We do, however, review our dividend policy. We know it's very important. So the moment we're back into cash flow to positive territories, we will definitely review our progressive dividend policy again. Looking at some operating KPIs, you see that our RevPAR obviously is down substantially from 19. This is mainly caused due to occupancy. If you look on the room rates, we're actually only 10% behind on 19, and that is due to the discounted business that we took in the year. We currently see a trend that room rates are already exceeding 2019. So in terms of our consolidated financial KPIs, it's very difficult to compare two COVID periods, 21 with 20. Because the trading dynamics are completely different. In 2020, we had a record January, February, whereas in 21 we were pretty much fully shut for the first 5 months of the year. Also, traveling in the summer of 2020 was much easier because we didn't have all the testing and the quarantine measures, which were there in 2021, which definitely affected our Amsterdam region. And if you look at our EBITDA, we were fortunate to report a positive EBITDA of 25 million this year, predominantly contributed by Croatia. In all the months that we had a negative EBITDA, we were supported by all the governments around in our territories, getting payroll support, getting fixed cost subsidies, and getting business rate waivers.
Okay, thank you, Daniel. So the outlook is that we are well positioned to benefit from the market recovery. As I've already said, all of our markets now are reopened after a COVID restricted period. One bit of fresh information which we can share, the current booking pace in the United Kingdom, which is the region which has opened up soon, opened up first versus Holland and Germany, is now trending at 65% of its booking pace versus 2019, which is very, very positive indeed and encouraging. The Netherlands and Germany have just opened and they're now starting to gain momentum. And as we've already said with our Hotel Brioni opening in Croatia, the demand for Croatia shows strong pent-up demand, and we are expected to recover to pre-COVID levels. We were starting to see pre-COVID levels in August and September in the Croatian region also. The full year for 2019, however, the recovery is expected by STR and real estate values is due to be 2024. So the external bodies and people who monitor, the data for hospitality are saying that 2024 we should start to see the recovery to pre-pandemic levels within the sector. So as we've discussed through this presentation, we do want to discuss with you and give you a summary that the management team are experienced, they're long-standing, they have a proven track record, and we're very proud of them. Number two is our business model. PPHE offers a unique exposure to the full hospitality real estate value chain. Thirdly, we have a strong track record. Consistent focus on growing equity value and capital discipline underpins our returns, as you've seen. And number four, the industry is regaining momentum, I'm pleased to say. So the industry has been heavily impacted by COVID. It's now regaining momentum. And as you've already seen, we've got strong investment demand for our hotel assets as ever present, especially with the deal we just did in 2021 at pre-19 levels. That's it in terms of a presentation from myself, Robert and Daniel. We're very much happy to answer any questions you may have.
That's great. Daniel, Greg, Robert, thank you very much indeed for updating investors this afternoon. Ladies and gentlemen, please do continue to submit your questions using the Q&A tab situated on the right-hand corner of the screen. But just while the company take a few moments to review those questions submitted already, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Meet company dashboard. Daniel, Greg, Robert, obviously investors have been able to submit questions throughout today's presentation, and I wondered if I could just hand back to you to open up the Q&A tab, and if I could ask you to read out the questions and give a response where it's appropriate to do so, and I'll pick up from you at the end.
Thank you very much, Mark. Yes, sure. I'll read out the first question. What is the planned reinstatement of the dividends? As we just presented, our dividends are very much linked to our cash flow. Our cash flow has been negative over the last 2 years, but has always been positive in the years before. Given that we think most of the COVID period is behind us, we feel we should be back into cash flow positive territories in the coming year. And if we are in cash flow positive territories, we will review our progressive dividend policy again. I read out another question for you, Robert. Can you also confirm the relationship with Radisson? Is the license perpetual? Are there targets that need to be achieved?
So I'll start with answering that the license is perpetual, it's exclusive, and it's not bound by any, for example, development targets. So our hotels operate based on a brand standards manual, and we are way above that brand standards manual. So there's no real escape within that sort of agreement from a Radisson point of view. I just want to emphasize that Our benefit is getting access to that system and platform and the marketing power. Radisson is not a property owner. They are a licensor of brands and management company. So they benefit from our property portfolio in high barrier markets. So we have the benefit in terms of access. They have the benefit that they now have exposure in London, in Amsterdam, with very good quality assets without putting any sort of capital in. So for their global profile and their global marketing and databases, we offer a value proposition as well, but it's not bound by any targets as such.
Next question for Greg. What impact has the Ukrainian situation on PPHE?
Well, at present, it's little. We are monitoring it as we go. What we did see was a slight slowdown of booking rhythm when it started. However, as the situation has continued, booking rhythms have started to recover. The only strategic concern we had was monitoring the booking rhythm with Croatia. Not that Croatia is near Ukraine, it's 1,000 miles from the border of Ukraine. However, we were just monitoring the booking rhythms and patterns on that region. And at the moment, they seem to be holding.
I'll take two questions here. One question is, what discount rate does the company use to get to an EPRA NAV of £22.15 on the assumption of a full return by 2025? All our assumptions have been included in the deck, in the appendices. The discount and cap rates depend obviously on the region that you're in. If you look at key city centers like London and Amsterdam, cap rates are around 5.5% and discount rates around 8%. If you go to the more Eastern European countries like Croatia, cap rates are between 8 and 9%, and the discount rates in the 10-11%. The next question is for Greg. Further to your expansion in Austria and Italy, is the plan to focus in these countries, or would you consider further countries? Why Austria and Italy in the first instance?
Okay, so I'll answer that from a backwards point of view. So why Austria and Italy? First of all, as a company, you know, some of our entrepreneurial DNA comes through here. As I said, you know, we are very astute in looking at assets. And as a company, we make sure that when we look at assets or territories, we want to make sure we get value. There is a lot of demand for 4-star upper upscale properties at the moment, and prices are at a premium. Where we have seen opportunity is in these Southern European areas. So second of all, we will be looking at other territories, but specifically Italy. There was some opportunity post-COVID, as a lot of the businesses or hotels in Italy were family run and not dominated by the global players as such. Therefore, post-COVID, there was opportunity as these families, etc., really wanted to liquidate their assets. And as such, there is some great properties and opportunities on market at the moment for there. Typically, if we invest in a region or an area, we do like to have scale. So we are openly looking at areas to grow within these territories, because we do, if we have one hotel, we may as well grow the infrastructure like we have in London and in Amsterdam. Austria really complements our outdoor strategy. Like we said, we have city centre core upper upscale hotels, but one area where we do want to grow and diversify is that outdoor area and segment. It's a ski hotel. It's you know, very predominantly you know, winter business. However, there has been a significant development also for walking, mountain biking, and activity related stays for our guest base. So as we've said, you know, travel trends are changing. Guests are changing in terms of their needs for hotels and businesses. So we very much want to continue to diversify the portfolio to make sure we actually drive demand and RevPARs all year round, and actually make us less sensitive to any future macro environmental impacts.
Okay, next question is for Robert. Can you give some flavor as to the success or otherwise of the glamping upgrades being applied to the Croatian properties?
I think this is one where we're sort of get very passionate about. What we have in Croatia is we have 8 campsites. and they are beautifully located along the coast. And a prime example is Arena 199, which was our first investment in a campsite product. It'd been operating for many years as a true campsite, so people would bring their own camper and caravan and tent. They would stay there for a few nights. They would sort of pay typically between 40 to 50 euros a night and would leave. What we've done there, because this is a peninsula, we closed off the peninsula, cleared some of the landscaping and pedestrianized the area and built an all glamping village. So across Europe, you see many campsites who have caravans, tents, and some glamping tents. But what we wanted to do is offer a full experience. So we introduced a glamping village, which only consists of luxury lodges. So fully self-contained units with bathrooms, kitchens, hotel linen that we have in our flagship hotels, Illy Espressamente, Tesla charging stations, yoga platforms, you name it. It's really spectacular. But what it allowed us to do is build this in a relatively cost-effective way. So it's not the cost of building a hotel, but effectively, we have created a hotel at a much lower cost. And typically what we charge in the high season now is between 250 and 300 euros a night. So not only did we have a lower cost of investment, we are seeing the significant rate premium uplift from going from sort of 50 euros a night to 250, 300 a night as a key success for us.
Next question is, does the company itself regard the 2025 full return assumptions of the valuer as sensible, or is there a lower figure they are using internal projections? To be honest, we are more optimistic, and the valuators, by the way, are targeting 24 as a full return. We are more optimistic, and we are more optimistic looking at today's booking pace. If we're already seeing today a booking pace in the UK, which is a market that recovered or opened up sooner than our other markets, which is already sitting at 65% of 19. If we're looking at Croatia, which is expected to recover fully to 2019, we internally have an assumption that is before 2024 to recover until our 2019 numbers. Next question is, who is actually undertaking the build redevelopment work? I seem to remember it was an internal related company for many of the projects. Is that still the case? So internally, PPHE has its own development department. We have our own design department. We have our own project management department. For external contractors, we are using a related party that is related to one of our founders. We are listed, we're a premium listed company. So we obviously always tender the work, and we're fully transparent towards shareholders whenever we do that. And we give shareholders a vote on these agreements, and our controlling shareholders are not able to vote on that. So even though this is a related party project, the vote is usually always with the non-related shareholders. Our contractor that we work with have always been able to build much more efficient, faster, and cheaper than the ones that we tendered for, and that's why we like to work with them. Another question, do you anticipate any change to the rate of recycling capital in the coming years as investment market for hotels heats up again? If you have more capital, do you have the project pipeline or the capacity to take more development projects? And another 3 questions in one, would you ever consider going fully capitalized model on the management platform? So let me first start with the amount of projects available and the amount of capital available. We currently see that there's more capital available than there are projects out there. So as you just heard, we have a unique capital approach. We sometimes do majority capital. We also do minorities. And we have partners that have enough capital available. So we have enough capital available for our current development line, but also for any new pipeline that we take up. Recycling capital in the coming years when the hotel market heats up. We are in this industry now for 30 years. And we've been doing this recycling along the line. So we recycle in cities and in values when it makes sense. We don't particularly look at markets that tend to heat up. I mean, the hotel market has heated up many times over the past 30 years. Would you ever consider going fully capital light? We think our strategy has proven itself, particularly due to these last 2 years of COVID. That strategy worked a lot. our asset-heavy base basically provided us liquidity, and it has always provided us with liquidity to grow the group further. I mean, the 350% growth since IPO, we could have only realized that with assets as a base, because that's the basis for recycling capital. So we firmly believe in that strategy. We do think that our hospitality management platform will give an extra value to the group, and that's why we today presented that to you. If there's no further questions, I see at this moment.
Yep, that's absolutely brilliant. Daniel, thank you very much, and to Robert and to Greg for taking the time to manage through those Q&A, particularly with the fire alarm as well that you had to navigate your way through. So thanks once again for your time today. I know investor feedback will be important to you guys, and I will shortly redirect investors to provide you with their thoughts and expectations. But before doing so, if I may, Daniel, if I could just ask you for a few closing comments to wrap up with, and then, as I said, I'll redirect investors to give you their thoughts.
Yeah, so for dialing in today. I hope we are we have the worst behind us in terms of COVID period. We're very optimistic as a management team, looking forward again, and this is a unique opportunity to step in and regaining momentum in our industry. Thank you very much for your attention today.
That's great, Daniel, Greg, Robert. Thank you very much indeed for updating investors this afternoon or this morning. Could I please ask investors not to close this session, as we'll now automatically redirect you for the opportunity to provide your feedback in order that management can better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of PPHE Hotel Group, we'd like to thank you very much for attending today's presentation, and good morning to you all.